The point of this video is to explain how money today works. And I'm following Perry Merling in the way he thinks about money. And he wrote an essay in 2017 called Financialization and its Discontents. It's a short essay. It's really worthwhile reading. And I put a link in the description. Let's go. So the first thing to understand is that banks create money out of nothing. And Merling calls this the alchemy of banking. And the easiest way to see this is to look at the banks and the households' balance sheets and to see that if a bank grants a loan to the household, it basically increases its loan balance, but at the same time, it increases the customer deposits. So the customer gets the equivalent of the loan, as an asset on his side. His deposits grow, but also his liabilities grow because he's now not only got his mortgage, but also loan to pay back. And that's entirely on the bank's balance sheets now. The loan has been granted and the customer gets a credit in their deposit. And that's it. It's actually that easy and that simple. But actually, there are two types of money in the economy. There's the money that banks create, and then there is central bank money, public money. And so we have to change the balance sheets a little bit and include the central bank money. So that's an asset for both the bank and it can be an asset for the household. And the only central bank money a household can actually hold is cash. So that's the money from the central bank that a household can have, whereas a bank itself can have an account with the central bank. So they can also have basically a deposit account with the central bank or take a loan out from the central bank to get access to this central bank money. So there are effectively two systems of circulation, one for the bank money and one for the central bank money. So why do you have this central bank money? And there's something that Merling calls an inherent hierarchy. So central bank money is better than private bank money. And why is that? Because central bank money is the money that banks use between themselves to transfer money. So Bank One might have loads of assets, namely loans to its customers on its balance sheet, but that's really in terms of its own Bank One dollars, say. If the customer transfers money from Bank One to Bank Two, Bank One has to give Bank Two money, right? Has to transfer money. And the only money that Bank Two is willing to accept is actually central bank money in normal circumstances. So banks between them use central bank money. You and I use actually our bank's money to pay for things. And our bank then uses central bank money to make good on our transfer to a friend who has an account at another bank. So this central bank money is also called high-powered money because it actually allows this whole system to work. And because banks can just create money out of nothing, there's instability effectively built into the system. Banks can expand or contract their creation of credit and money during the cycle. And so you can get financial cycles in the economy. So the central bank really is there to impose some discipline on banks and, in cases of crisis, jump in and prevent a systemic collapse, basically, which we saw during the financial crisis of 2008. The central bank effectively became the lender of last resort to keep all the banks liquid. There's a fifth point that Merling doesn't have in his essay, which I would call the historicity of money. So it's just the idea that actually money that we see today has evolved to be like this. The system has evolved. Central banks were not always there, and when they were invented, so to speak, they didn't really know what they were doing. They didn't have the functions that they have today, and they didn't really understand how to fulfill those functions until very much later. So they learned by doing over time. So what we see today is really a long evolution of how central banks and the monetary system works. And so there is no, given way money works. We have to actually always see it from the perspective of how it has evolved into its current form. So some of the oldest central banks, like the Bank of England, started off as the bank of government, really to ensure that government could get credit to wage wars. And only over time did the Bank of England, the bank of government, become a central bank that actually made sure that the banking system worked. And over time, it started to regulate the system, and over time it actually evolved into the lender of last resort to prevent banking crisis. So monetary policy, like interest rate policy and the idea of managing money in order to manage inflation, came very, very much later. So first it's a government bank, and then it takes on regulatory functions for the whole system, and then very late it becomes a monetary policy organization. However, not everyone's a fan of central banks, and there are two main criticisms of how central banks operate. One is very much a free market view, in which the central banks prevent the creation of liquidity and starve industry of credit. And the other view is that central banks actually, because they're in the pockets of government, produce too much liquidity and create inflation. And the solutions are very different. On the one hand, in order to actually promote liquidity, you free banks from the fetters of central banking and let them do whatever they want. They're private businesses, and they don't need the heavy hand of a central bank to tell them what to do. On the other hand, if you want to minimize the central bank's ability to produce liquidity, you give it rules. It's a very rule-bound policy, and you eliminate discretion effectively. So you avoid hyperinflation by limiting banks to very strict rules. Now, I don't think either of these views really hold water, and they don't really take seriously the system-critical functions that central banks have in terms of both doing monetary policy as well as being the lender of last resort and regulating the banking system, imposing discipline on the banking system when it is needed. So when you learn about money, normally you talk about the functions of money, as a means of payment, a unit of account, a store of value. Well, I think actually money is principally a means of payment, and the question of unit of account and a store of value are really attributes. You can't have a means of payment that is not a unit of account. You can't have a means of payment that is actually not a store of value that you can't trust in. So, however you want to look at it, I think really thinking of money as a means of payment in the first instance is probably the most useful way to conceptualize money. So why is money important? mainstream economics would tell you that actually it's not that important. It's a veil over the economy, and what matters is what's happening under this veil, the real economic relationships, how much is being produced, the income that people get, which is actually always in money terms, but isn't thought of in money terms. And when we look at reality, without money, economic activity would stop. It's of system critical importance, like blood in the bloodstream. But beyond that, without money, it's hard to think how we would grow, because banks can create credit and money out of nothing, which really fuels growth, which allows industry to grow. This idea that savings create the funding for investment is right to some extent, but in order to actually get an expanding credit, expanding economic activity, you need banks, you need credit. So one has to recognize that, and has to recognize this important feature of modern money to actually understand the economy properly. And thirdly, in a modern monetary system, the central bank sets interest rates, and those interest rates are important throughout the whole interest rate structure. They set, you could say, an anchor at the short-term interest rates. And so what the central bank does has impacts on the whole economy. So monetary policy is definitely a key driver of what happens in reality. So you can't abstract from that in any way, shape, or form. So money is of crucial importance to economic activity.